For the past few years, America's economy has been the envy of the developed world, consistently outperforming its peers in key areas such as GDP growth, productivity, and wage increases. Inflation, which had previously soared, steadily declined and reached a low of 2.4% year-on-year in September. However, in recent months, the U.S. economy has started to show signs of instability. Consumer confidence has taken a sharp downturn, the trade deficit is expanding, and inflation appears to be stubbornly persistent. While the official data won't be released for a couple of weeks, the latest GDP Now forecast, a real-time GDP estimate maintained by the Federal Reserve Bank of Atlanta, indicates that the U.S. economy could shrink by a staggering 2.8% year-on-year in the first quarter. To understand this sudden shift, it's essential to break down what's happening in the economy. GDP is typically measured as the sum of four major components: consumer spending, private sector investment, government spending, and net exports. Recently, most of these components have been in decline. The most significant drop has been in net exports, which is calculated by subtracting imports from exports. A key factor behind this decline is a phenomenon known as front-loading. Businesses, anticipating the imposition of additional tariffs in the near future, have rushed to import goods before these tariffs take effect. This surge in imports has not been matched by a corresponding increase in exports, resulting in a lower net exports figure. Adding to the complexity is the strength of the U.S. dollar, which has appreciated due to expectations of further interest rate hikes aimed at curbing inflation. A stronger dollar makes U.S. goods more expensive abroad while making foreign goods cheaper for American consumers, leading to an increase in imports. In this context, the rise in imports is somewhat expected ahead of potential tariffs, meaning the current administration may not see this as an immediate cause for concern. However, the decline in net exports is only part of the story. Consumer spending, which had previously been a major driver of U.S. economic growth, has also weakened considerably. The Atlanta Fed's latest estimates show that year-on-year consumer spending growth has fallen to nearly zero, a sharp drop from the approximately 2% growth seen last year. This trend aligns with data from other reputable sources, such as the University of Michigan and the Conference Board, which conduct two of the most widely respected surveys of consumer sentiment in the U.S. The University of Michigan's monthly survey revealed that consumer sentiment fell sharply in February, driven largely by rising inflation expectations, meaning consumers believe prices will continue increasing over the next 5 years at the highest rate since 1995. Similarly, the Conference Board survey noted a steep decline in its expectations index, which reflects consumers' short-term outlook on income, business conditions, and the labor market. Alarmingly, for the first time since June 2024, this index fell below the threshold of 80, a level that typically signals a looming recession. Business confidence surveys paint an equally concerning picture. For instance, the ISM Manufacturing Index, which gauges the health of the American manufacturing sector, showed that manufacturing activity stagnated in February. The only reason it didn't contract further was the very same front-loading of imports previously mentioned. What makes this situation even more precarious is the growing concentration of consumer spending among the wealthiest Americans. Analysis by Moody's indicates that the top 10% of earners now account for an unprecedented 50% of all consumer spending. Since overall consumer spending has stagnated, this implies that the bottom 90% of Americans are already experiencing economic conditions that resemble a recession. Moreover, this wealth concentration makes the performance of the stock market more critical to the broader economy than usual. Typically, the stock market is seen as distinct from the real economy, but when wealthy Americans, who hold a substantial portion of their wealth in stocks, drive consumer spending, market downturns can lead to reduced spending and potentially tip the economy into recession. While not all of these developments can be attributed to Trump, his policies are undoubtedly contributing to the economic uncertainty. Some of the robust consumer spending seen in 2022 and 2023 was fueled by pandemic-era savings, which have now been depleted. However, many surveys point to tariffs, or at least the threat of them, as a key factor behind declining consumer and business confidence. The fear of higher import costs is fueling inflation expectations, which in turn could prompt further interest rate hikes from the Federal Reserve. Polling data reflects this shift in sentiment. Trump's once strong approval ratings on economic matters have deteriorated. His net approval rating for handling the economy recently hit a record low of 12, according to some surveys, while Ipsos recorded a drop from +4 in January to 8 in February. Inflation remains another pressing issue, proving more persistent than previously anticipated. After hitting a low of 2.4% in September, year-on-year inflation has steadily climbed back to 3% as of January. Trump's tariff policies threaten to exacerbate the problem by increasing the cost of imports, which could push the Federal Reserve to either maintain high interest rates for longer or implement additional rate hikes. It's perhaps no surprise that Trump's allies, including Elon Musk, have begun publicly criticizing the Fed. Finally, the national debt adds another layer of complexity. Concerns over Trump's fiscal policies have been long-standing. On the campaign trail, Trump promised tax cuts without outlining any meaningful spending reductions to offset them. Initially, there was some hope that his administration might identify enough budgetary savings to balance the books. However, those hopes have largely faded. Trump's own figures admit to only a few $billion in savings, a negligible amount in the context of a $7 trillion budget. Furthermore, the most recent Republican budget proposal, which Trump endorsed, is projected to add at least another $2 trillion to the deficit over the next decade. While U.S. borrowing costs have remained relatively low in recent months, this is largely due to investors seeking safe assets amidst economic uncertainty. In the long run, the U.S. cannot rely indefinitely on cheap borrowing, making the current fiscal trajectory unsustainable. In summary, while it may be too early to make definitive claims, the American economy appears shakier than it has in quite some time. Factors such as front-loaded imports, weakening consumer confidence, stagnant spending, the growing influence of wealthy Americans on economic activity, persistent inflation, and mounting national debt all contribute to an increasingly precarious economic outlook. Whether these challenges will push the U.S. into a full-blown recession remains to be seen, but the warning signs are becoming harder to ignore.